what explains this? I mean, buybacks? I mean, are you mining lithium? Like what gives?
Well, I think it's pretty simple when you step back and you look at it. Number one, EQT is a very high quality company. We've got world-class assets, a low-cost structure, investment-grade balance sheet, and a balanced hedge book. All of this produces a durable free cash flow profile that endures through the downtimes, and it sets up a pretty bright future. We've got a 5-year free cash flow forecast that will allow us to retire the entirety of our market cap. In addition to that, it's the quality of the product that we produce in a world that struggles with energy security, in a world that struggles with rising emissions. Our product, natural gas, addresses two of these issues, and natural gas is going to be the energy of the future.
Yeah.
And for those two reasons, the value is being reflected in the performance of our stock.
I just read that after shutting down Indian Point, the nuclear plant in New York, that its nat gas use is up. We've talked before about the fragility of Northeast nat gas supplies, so not to get off on that tangent, but just to talk about conditions in the market more broadly. I mean, as we start to see, have we seen the normalization of the Louisiana facility and some of the others that are going to kind of normalize nat gas prices here in the U.S. or not? I mean, when do we get back to normal? What is normal?
Well, what we've seen today, we had that unseasonably warm winter, which pulled a lot of demand out of the market. You've seen operators respond. To date, we've seen a 15% drop in activity counts that will help balance the market. But, we're sitting with pretty low prices as expected when we have, significant weather events like that. But we are looking at rising prices in the future. And while storage levels are relatively full here in the United States and in Europe, recognize not really much has changed. Structurally, we're still having a challenge getting pipelines built. Inflation is still rampant. The war in Ukraine rages on, and global emissions are still surging. So this is a brief period of time where consumers are getting some relief on low prices, but I think we're in the eye of the storm, and we need to take action with permit reform to be able to let this industry get back the industrial capacity so we can protect Americans and our allies around the world with energy security and the ability to lower global emissions with this natural gas that we have.
Yeah, I mean, permit reform is getting so much attention these days. You feel like, okay, maybe something's finally going to happen on that front. Let me ask you about some of the deals lately and how much more deal making needs to happen for the space to be kind of a better return to shareholders. I was struck by who was the deal today with Exxon and the assets where they're paying like a 10% premium. That's nothing, right? Like, what does it tell you about sentiment in the energy space? Granted, that's oil, what have you. But when people are just saying, you know what, I don't know what this cycle is going to look like. I'll take in this case, Chevron, I'm sorry. In this case, I'll take the Chevron shares, swap those better asset for my shareholders and walk away. I'm just curious about sentiment and the prospect for decent returns over the next couple of years and how much consolidation needs to happen.
Yeah, Kelly, we have a very fragmented industry here. There's thousands of operators, and at this point in time, the exploration's been taking place. We've done the discovery. Now it's about harvesting. And I think you're seeing some of these smaller operators look at their assets and say, how am I going to create the most value from this asset base? Is it going to be part as a small company, or is it going to be part of a much bigger company that has greater scale and can provide greater opportunities? And so that is, I think, that motivation for these smaller players to make that determination themselves. That's what we've seen other operators make that decision by trading into EQT. And as the global commodity for natural gas breaks out from being a regional commodity and becomes more of a global commodity, the opportunities only get bigger, and the scale is really going to be a differentiator. And, companies like EQT can offer that scale and create value. And I think you're seeing that same type of determination being made on the oil side as well.
And I guess the last question, and I don't know if, everyone talks about how we're about to have an El Nino cycle, if that's bearish for nat gas or bullish, but if other companies want to emulate, the outperformance that you have posted so far, what would they have to do to clean themselves up or to kind of have the right levers to pull in this kind of environment?
Well, I think we've got some really differentiated aspects of our business. It's going to be incredibly difficult to replicate the high quality asset base that EQT has today. Yeah, it's going to be very difficult to get that IG grade balance sheet. EQT is certainly unique in that aspect. And just taking an overall disciplined approach in the actions that we've taken to date as it relates to M&A. We're not just looking to create to drive accretion on free cash flow per share and NAV per share. We're also looking to do deals that make us a better business, lower our cost structure. So we've got a pretty unique strategy. I think that's bearing some fruit and showing some outperformance. But this isn't rocket science. Commodity business. There's some keys to success, and EQT is staying disciplined to creating the most value for our shareholders.
And I'm glad you made that comment about kind of, what kind of M&A you would be interested in. I mean, obviously we had the One Oak Magellan deal. I don't know if that's ever something that would be interesting to you, but what would actually lower your expense base? I mean, what kind of deals would even fit what you're looking for right now?
Well, high quality assets is a good start. We're in the process of closing on a transition with Tug Hill. That is an asset that will lower our cost structure by 15 cents. And that's pretty significant. That would have an impact of lowering our cost structure by about $300 million per year.